Hey, what's up guys, welcome back to the channel. So in this video I want to do a quick update as to what exactly has gone on in the stock market and in the Russian-Ukrainian crisis, as even though it might not seem that the stock market has reacted all that much to this very big macroeconomic and geopolitical event, there are some pretty big underlying effects that we're going to start seeing from this entire war happen over the next few months. So I think it's very critical to address those right now and also have a look as to why stocks have been crashing so much over the past 2 days specifically. As you guys can see, just today we had the Nasdaq, the S&P 500, and also the Russell 2000 down by around 1.5% on average. Now obviously over the last few weeks we have actually seen small caps lead the large cap companies, which means that we were potentially in more of a risk on environment, as a lot of investors saw some value in a lot of these beaten down small cap stocks, just like I'm seeing right now. But clearly over the past few days, as we've seen this fight erupt at the nuclear power plant in Ukraine, and we've also seen a big effect of sanctions on the Russian economy, the stock market in the United States is trying to price in some of the more lingering effects that's going to have on trade and exports for the United States itself. And as you guys might have heard, there was a ceasefire talk with Russia and Ukraine a few days ago that actually rallied the stock market quite significantly. And that's probably one of the big reasons why stocks reacted so poorly over the past few trading days, as a lot of that ceasefire talk got evaporated into thin air. And we're still seeing Ukraine kind of go out there and encourage Russia to potentially do a ceasefire so that civilians can actually get out of Ukraine and Russia can do whatever it wants with Ukraine and the fight can continue. And obviously more recently we've had Russia block access to some of the big social media giants like Facebook and Twitter in their country, which I don't think is going to have that big of an effect on these stocks specifically. But again, there could be some more macroeconomic and more legal consequences that arise from the situation. And obviously the stock market does not really want to hear that. And that's probably a big reason why we saw the volatility in the market today. As for what exactly is the state of the Russian invasion in Ukraine right now, as you guys can see, unfortunately, there's been a lot of progression from the Russian troops from both the north, the east, and the south from Crimea, where Russia have obviously taken over the city of Kherson. And on the right side, Kharkiv is potentially going to be falling very soon, which I think is going to be the biggest downdraft for Ukraine outside of a potential takeover of Kyiv. And obviously more recently we had the nuclear power plant down in the south also get taken over by Russian forces, which means that right now Russia has a pretty big control to potentially squeeze out a lot of the troops that are situated on the Ukrainian side in Kyiv and push them out west. Now, as you guys can see, out west we don't have any major economic cities for Ukraine, which means that Russia is unfortunately in a very much strong position here, unless and until we see some serious actions from NATO and a potential economic effect from all the sanctions that we've issued on Russia. But again, we don't really see that happening right now, and that is something that a lot of investors are scared about. But if you guys have been keeping up with the news lately, aside from the Russian invasion progress, we've seen a lot of news come out from the Federal Reserve and obviously the latest unemployment report, which actually both came in very bullish for the stock market and actually rallied the S&P 500 on Tuesday and Wednesday. Jerome Powell actually came out to Congress and said the fact that he expects a 25 basis point hike to actually happen next month, which is pretty much what everybody on Wall Street actually expected to happen. And that definitely kind of strengthens a lot of the bulls' argument for buying the dip in the market right now, because obviously a 50 basis point hike would be much more aggressive. And with this macroeconomic and geopolitical situation, there is no reason for the Federal Reserve to be more aggressive, because there could be actual economic and labor market impacts of what's happening in Ukraine. But as you guys can see, just today we got the unemployment report come out, which came in very strong and added roughly 678,000 jobs, which is a very big improvement from what we saw happen in January and December. And that definitely goes to show that the underlying labor market in the US is very strong. And so a lot of the Russia-Ukraine related economic effects might not have that much of an impact on the strong momentum we're seeing in the labor market, which is something I think the stock market is potentially going to try to price in over the next few weeks. But aside from just the headline number, there is a very bullish thing underneath this report that hints at inflation not lasting as long as many investors have kind of priced into the stock market. And that can be found by scrolling down and looking at the average hourly earnings for all employees on private non-farm payrolls. And as you guys can see, that was at around $31.58 in February, which was actually little changed over the month of January, which means that there is a significant risk taken off where we could be seeing this potential wage price spiral that could drive inflation much higher even if supply chain issues get better. And that, I think, is kind of the worst case scenario that a lot of investors have kind of priced in for inflation. So generally speaking, unless the CPI report next Wednesday comes out extremely poor, the inflation situation so far is getting a little bit better. As for what I've been personally doing in the market, you guys know my theory. I've been buying the dip on some of my favorite companies. And today I got a pretty big opportunity to do that because, as you guys can see, a lot of my stocks in my own growth portfolio were down on average like 7 to 8% today, particularly on the small cap side. As you guys can see, Facebook, Alibaba, and PayPal were not actually down that much, which means that the S&P 500 has by far outperformed the Russell 2000 ETF. And that is clearly the case by looking at the percentages. But generally speaking, for me, I find a lot of opportunity in a lot of the geopolitical situations that we're seeing priced into the stock market. Now, obviously, there is a big humanitarian crisis and there's a potential big conflict situation risk that could arise between NATO and Russia. And that's something we obviously want to keep in mind. So it does not make sense to just go all into the stock market, but it does make sense to take advantage of the deals that your favorite companies are providing you as their stocks are slowly coming down, because we never know when these deals might go away. And a big supporter of the buy the dip theory is the fact that the VIX, the volatility index right now, is at its all-time highs for at least the past year or so, which means that the market is potentially pricing in a very, very volatile environment right now. And historically, if you go down to the 5-year time frame, whenever the VIX has traded high for a prolonged period of time, it's always been very good buying opportunities for long-term investors, not only in small caps, but also in large caps. And more recently, the trend has been that the VIX has actually made higher highs and higher lows, which means that potentially we could see a move to this 40 level over the next few weeks, especially if we see some sort of contact between NATO and Russia, which I definitely hope does not happen. And as we know, in the long term, it definitely pays to be bullish when everybody else is bearish. And clearly the sentiment right now from most investors, especially on the retail side, is that the market's going to crash and that we're going to see a very big correction in both the market and the economy. And obviously a lot of that sentiment is being driven by a lot of media headlines, especially like this one where Warren Buffett is apparently now holding $144 billion in cash instead of buying more stock. And although on the surface this article seems very convincing, if you actually do your research, you realize that Warren Buffett particularly looks for value investing plays. What that means is that Warren Buffett is not looking for growth stocks. Instead, he's looking for large cap companies that have very established businesses, and he's looking to buy the dip on companies that are trading at very good PE ratios. And what I'm personally doing is I'm doing the exact opposite. I am buying small cap companies that are very high growth because that is exactly where I'm seeing the deals in the market right now. And as you guys can see by the S&P 500, 400, and 600 PE ratio graph, large caps are definitely trading at a pretty expensive price right now, which is probably the biggest reason why somebody like Warren Buffett and a lot of other hedge funds right now are still sitting on cash and waiting for some bigger deals. Because as we all know, a lot of these indices and a lot of big money investors primarily focus on investing in large cap companies that have north of $100 billion market cap. Because at the end of the day, that's where the profits are, that's where the cash flow is, and that's where the risk is the lowest. As you guys can see, more recently, we are literally trading on 10-year lows in terms of valuations on both the mid caps and the small caps, meaning that basically every stock underneath a $10 billion market cap right now is sitting at a very good deal compared to where it was a year or two ago. But obviously you want to keep in mind that large caps might still have some room to go, and that might certainly drive down indices like the S&P 500 and the Nasdaq a little bit lower over the next few quarters. And that's going to be seen through the moves we've seen through stocks like Snowflake after they reported earnings a few days ago. These large cap companies have a lot of room to the downside, and the volatility we're seeing in terms of the after hours and the pre-market moves in a lot of these companies just goes to show that a lot of large cap companies are very, very overvalued right now, and that you definitely want to be careful, similar to Warren Buffett, before investing in a lot of these very, very established businesses. But anyways, guys, make sure to drop me a thumbs up if you found some value from this video. Let me know down in the comment section below what stocks you guys are buying the dip on, and what are your thoughts on this Russia-Ukraine situation and what the Federal Reserve said earlier this week. But anyways, guys, I hope you enjoyed this video, and I'll catch you guys in the next one. Take care.